In this video, I want to emphasize why investing too much, on a one-stock capitalization size can hurt your portfolio. In other words, if you choose to invest only in small caps, or you choose to invest only in mid cap, or you choose to invest only in large caps, this kind of decision can hurt your portfolio, in the long run. So why investing too much in one stock cap size can hurt your portfolio? Let's look at these contents, one by one. Number one is concentrated risk exposure. Concentrated risk exposure. You discover that generally concentration is never a good thing when it comes to investing. You don't concentrate. So when it comes to small cap stocks, investing too heavily in small cap stocks exposes you to a significant level of volatility. Small companies often face higher risks of failure due to their limited financial resources, competition, as well as sensitivity to economic downturn. They are quite sensitive to economic downturns. So during recession, these stocks can suffer dramatic losses. When recession sets in, you discover that small cap stocks will take the highest, amount of hit. So you also look at mid cap stocks. As for mid cap stocks, while mid cap stocks offer a balance of growth and stability, and over concentration in this segment can result in moderate risk. Not only that, mid cap stocks are more sensitive to market cycles than large caps, and they may underperform during periods of market instability. Although they are less sensitive, compared to small cap stocks, they can still be exposed to underperformance during market instability. So as for large cap stocks, actually large cap stocks tend to be more stable. But you don't just follow that stability and become over concentrated in it. No, but over concentration in this sector could lead to missed opportunities, because whenever you invest in a particular stock in a particular segment, you are doing that at the expense of what they call it, opportunity. There's opportunity cost involved. Alternatives forgone. It's elementary economics. It's still applicable to the stock market. And so these stocks often provide lower returns during periods of economic expansion compared to smaller companies with higher growth potentials. If you concentrate solely on large caps, you will miss the growth potentials that are found in a small cap stocks. Number two is a lack of diversification. Lack of diversification. So there's this limited sector exposure. Focusing too much on one market cap segment might lead to an exposure to certain sectors or industries. So you are kind of overexposed to what is called sectoral risk, or sector-related risk. For example, if you invest heavily in small cap stocks, you might unintentionally increase your exposure to higher risk sectors, limiting diversification and increasing portfolio risk, so you don't over concentrate. Another one here is missed growth opportunities. Missed growth opportunities. So overweighting one market cap category can prevent you from taking advantage of growth in other segments, particularly in the small cap segment. You just forgo the growth completely that occurs in the small cap and the mid cap sector. For instance, this may offer greater upside. You discover that small and mid cap stock can offer greater upside, potential during economic expansion, while large cap may provide, ready, steady, but limited growth potentials compared to small and mid cap. The large cap, if you over concentrate, on large cap, you will miss the growth potentials that is exhibited by small and uh, mid cap stocks, mid cap category. Number three is volatility and market timing. So there's that small cap exposure. Small cap stocks are more volatile and can result in greater portfolio fluctuations. If market conditions turns unfavorable, this can lead to significant losses, especially if you are overexposed to a few small cap stocks. If you are simply investing only in small caps and just a limited number of them, then you'll be exposed. There's that particular risk of overexposure. And if that sector performs poorly, you could get your fingers burnt. Then there's what is called large cap exposure. So relying too much on large cap stocks might limit the overall returns of your portfolio during periods of economic growth, as large cap companies tend to grow at a slower pace compared to smaller companies. They grow at a slower pace. And so you will miss that opportunity because you are over concentrated in large cap companies. Number four is, before then, please subscribe to this channel and like this video. And if you've watched this far, please don't fail to ring the notification bell. Number four is performance inconsistency across market cycle. Performance inconsistency across market cycles. So you have economic downturns. How do they perform? In a typical, downturn phase of the economy. In a recession or downturn, large cap stocks tend to be more resilient, while small cap stocks can suffer greater losses. So overloading your portfolio with small cap stocks in such a time can expose you to considerable level of losses. So in a bull market, during market expansion, small and mid cap stocks generally outperform large cap stocks because they are small, they are nimble, they can grow very fast. By over investing in large cap stocks, you could miss out on significant growth that are exhibited by small and mid cap stocks during bullish periods. You can miss out because you are over concentrated on large caps. Number five is an increased risk of underperformance. Increased risk of underperformance. By failing to diversify across market cap sizes, you could unintentionally create a portfolio that underperform over the long term. This can lead to inconsistent returns, greater exposure to systemic risk, and potential underperformance compared to a well-diversified portfolio. So, investing too heavily in one size of stock capitalization can expose your portfolio to greater volatility, and as well as missed opportunities forgone. And this will lead to inconsistent performance. So a well-balanced portfolio that includes a mix of small, mid and large cap stocks helps manage risk, maximize returns, and enhance diversification, allowing for a more resilient investment strategy over time.